some things he can't talk about because it's a highly regulated industry. So he will let you know if he can answer that, or if there's another option afterwards on how he can answer that question for you. Okay? Any questions about that? All right. And then I have Ryan Vaughn, and he is our consumer lending manager. So anything about loans, anything about credit, he's your guys. They both can kind of answer for both, but I'm going to go ahead and kind of start us off with some questions that some of you may or may not have submitted to kind of get the juices flowing. But at any time, if you have any question that you don't know about or that you want answered, just raise your hand and we'll call on you. Any question not asked is, there are no dumb questions. Let me just put it to you that way. We're all friends here, right? We're all compadres, and we've all been in your shoes and didn't know the answers at one point or another. So this is a really safe, great environment to kind of get to those answers. So I'm going to give one microphone to Steve and the other to Brian. And we'll get started. We'll start with some basics. And so, if you guys want to come up front here, you know, like roam the crowd, mono with everybody, you know. All right. I'm going to ask Ryan first, since this is the first time he's done it, so we need to like baptize him in this. Ryan, what is the best way, in your opinion, to build credit?
Yeah, great question. So I know that's one of the most common things we think about when we are going through college. I was there not that long ago, how do I build credit, transitioning into the working world. So I'll give you a couple tips, the things that I wish I had known when I was 18, 19 years old. First and foremost is going to be getting some type of loan. So getting a loan is a bit challenging, especially if you're not employed and you do not have any credit, but there are products out there for you. So one of the things that I'll mention is called a share secured loan or share secured credit card. I'll tell you what that is. The goal is going to be for you to save up some money to open this product with a financial institution. Most credit unions are going to offer this. Most banks also have a product like this. So what you'll need to do, you'll need to save up some money to meet what the minimum amount is. For Pin Air, for example, that minimum is $500. So what we will do once you save that up is we can secure that money and then give you a credit card or a loan based off that security. So that is available without credit and without a job or employment or income. So great option there if you're looking to establish some credit. I recommend if you're turning 18, you've got graduation money, maybe you've got some money from your parents after going off to college. Open up the secured loan, go to your bank, go to your credit union, get that established, and it will start you building credit immediately. So what you'll do once you establish that, you'll make your monthly payments. If it's a credit card, you can keep that. You can spend on it monthly, you can pay it off each month, and then once you've established enough history, most institutions will then be able to convert that to a normal credit card. So something we do at Pin Air all the time, we coach through that, we see that opened, and then we actually convert it into a normal credit card where you can go on spending each month. So one of the best ways off the bat to start credit. And then one other option, a lot of credit unions, banks, specifically Pin Air, we offer options to our members to actually help them with a credit builder type loan. So a lot of institutions will have that. Check with your bank, check with Pin Air if you're not a member already, but we have a credit builder loan that if you meet some criteria, including having some income, we can get you that loan that will help you establish some credit as well.
Yeah. So I worked at a bank and I worked at a credit union. And so there's some terminology. So I'm gonna throw that out here so you understand the difference. At a credit union, we call savings accounts shares because you're an owner of the credit union. So it's your money that's being deposited, it's your share. Where a bank just calls it a savings account. A certificate, we call it a share certificate, but a CD, you might have heard that terminology, that's a bank terminology, same thing. But yeah, both financial types of institutions, we call them FIs for short because we are all about the acronyms. FIs offer these products and services, so you're more than welcome to come to Pin Air, but you're more than welcome to ask your FI about these products and services. So, good job, Ryan. All right, let's ask Steve a question. Steve, where do we start in regards to savings and investments?
Yeah, we get this question all the time. But before I forget, because I've reached the age where I'll forget things, so Dan was talking about the terminology of the credit union. Another helpful word for y'all to know is dividends. In the credit union, we call the interest you make on your savings account dividends. And so also you might hear that in relation to investing. Some stocks pay dividends. The credit union, you have dividends, but that's really the same thing as interest. So where do you start with investing? Well, the first thing you have to do is get your financial house in order, which is to say, live on less than you make. If you're spending more than you make, it's kind of hard to have anything left over for investing. And that's the biggest mistake I see folks make, is they will jump out there, start buying some stock. Well, Apple's got to be a great company, I'm going to buy some of that. Then the car breaks down, or the AC goes out, you have to sell your stock, which might be up or down. You don't know. So you can incur a loss because you're having to sell it in a panic situation to fix your car. So you start by getting a financial foundation laid, which is usually, most financial advisors will tell you 3 to 6 months living expenses. So you get your foundation laid, then you research some investments. You want to go by whatever your risk tolerance is, meaning that's a fancy way of saying, can I deal with loss? Can I deal with my investments going up or down? If you're very conservative, you want to start out with something that's going to be more steady. You don't want to go with something, a high-tech stock. Start with a mutual fund. Mutual fund is a fancy way of saying just a group of investments that's professionally managed. And so you send the mutual fund company some money. You can start out with just $50 with some of them online. And the manager will decide what stocks or bonds or other investments to buy. You don't have a say-so in that. Yes, sir.
Is there like a common dividend that comes with mutual funds? Like if so, average maybe?
Like a common average of return on a mutual fund?
Okay, so make sure I understand the question. You're wanting to know what an average dividend would be on a mutual fund? It depends. You'll find a lot of my answers sound like a politician. He's not answering the question because there's so many exceptions to it. So let me explain why I'm saying it that way. Some mutual funds do not pay dividends at all. It doesn't mean they're bad. Some growth-oriented mutual funds are designed to grow the value of your investment. Dividends are usually a source of income that people are interested in, so they have a different goal. So you might say if you took all the dividend-paying mutual funds and averaged those, maybe 2% and 2.5%, which is roughly what the S&P 500 might pay in general. Now you can find exceptions to that. There's mutual funds out there that pay 11 or 12% dividends. And again, there's mutual funds that are growth-oriented and pay no dividends. So it depends on what your goal is. If your goal is to grow your money for retirement, which is, I'm guessing, what many of y'all may be, versus income to live on, you would want something that's not necessarily going to pay dividends, something that would grow. Now, if you're older, like me, and you're saying, hey, now I'm accumulating some money, one day I'm going to have to live on this, then that would be more dividend-oriented. I want something that pays, say if I find something that pays on average 5%. So if someone had $1 million and it's 5% dividend yield, well, that's $50,000 a year coming in. We're just sitting in the Barca Lounger doing nothing. Did that answer your question?
How many of you guys think it's feasible for you to have $1 million in your retirement fund by the time you retire? Do you know how to go about doing that? Steve, you want to give us a quick lowdown on how to do that?
Yeah, I can actually tell you. You can even, now here's the disclaimer. Pam had mentioned a lot of the the investment business is very regulated, which it is. So I have to give this disclaimer. That what I'm going to say is for educational purposes only. And some people might say it's for entertainment purposes only, depending on what you think of my answer. But it's not to be construed as, oh, well, that guy from Penn Air told me this is what I should do. So it's not investment advice. With that said, you can take $50 a month, starting when you graduate and get a job, so presumably about age 22-ish for an average person. So age 22 to age 65, you invested just $50 a month, 50 to 75, at 10% compounded to age 65, you'd have $1 million. So it's not hard to do. The hardest part is the time. Or $50, anyone's got $50. But can you invest it systematically every month for 45 years to get to be age 65? That's the hard part, because life happens. Oh, now I got to pull from this. I got to do that. It only works as if you can leave the money alone. That's why I said you have to get your financial house in order. You're not going to have $1 million if you invest $50 a month in that mutual fund. Every time the car breaks down or you need to buy something, you raid the investment. It has to be untouched for it to work, and that's the part that's easier said than done.
Yeah, I think both Ryan and Steve would say top three best practice: pay yourself first, put that money away, suffer, have one less outfit, one less trip with your friends on the weekend, one less thing, because your older self will thank you for it.
One less meal, you eat free like here when you can.
Yeah, exactly, right? How many of you in here, if you don't feel comfortable raising your hand, it's okay, you don't have to, but how many of you are going to graduate with student loan debt? It's probably a big stressor, right? You're like, how in the world am I, what are my next steps? What do I do? So Ryan, can you kind of talk a little bit about the importance or how to go about consolidating your student loan debt?
Absolutely. So, it's one of those government loan processes that most students who graduate will graduate with some student loan debt. Unfortunately, that's the environment we're in, but there are ways to pay that down systematically and then eventually consolidate and refinance. One of the things I'll encourage you to really look at on your student loan debt, not only while you are in school, but also after school, is what are the terms of the loans? They're very different. I'm not an expert on the terms specifically, but I recall from my days in having student loan debt that the rates can vary. Some are as low as 3-4%, some maybe as high as 8 or 9. I think a lot of that depends on whether it's a private student loan or whether it's a government subsidized student loan. So look at your terms, make sure you know what the interest rate is on those loans. Make sure you know if interest is accruing while you're in school or if it starts after school. Most do not realize that it's actually accruing while you're still in school. So although you may have only borrowed $5,000, by the time you graduate, that may be $7,000, $8,000, and that can accumulate over time. So be familiar with what your terms are so that you know the right course of action when you graduate, and potentially even before you graduate. If you are working through college, you have a job, there may be an opportunity for you to be able to refinance that into something that has a lower interest rate while you're in school, and that could lower your payments. So one thing I will say, once you've established credit outside of college, the most important thing is developing a plan. So Pam made the comment, pay yourself first. It's a great tactic. However, set aside a certain amount monthly to pay on those loans. If you pay the minimum, it will be challenging to pay that off within a reasonable amount of time. A lot of the student loans are amortized, which means the term of the loans can be anywhere from 5 years, 10 years, 15 years, and most of us don't carry that 10, 15 years after college. So familiarize yourself with the terms, set a plan. There's a lot of resources out there that can help you establish, if I pay $400 a month, when will this loan be paid off? Set a plan, stick to it, make sure that's one of the first expenses that you're covering each month to pay off these student loans, and then hopefully within a reasonable amount of time, you can get those paid down or paid off. Knowing the terms, most important. A lot of opportunities out there if you did want to refinance, but some student loan programs have very favorable interest rates, so it may not make sense for you to refinance long term. So summarize, set a plan, follow that plan, and it will get you to pay those down in a reasonable amount of time.
So I have a question. I'm 2 years out, or 2 years ago, a student loan payment is about 40, 50 months before they go up there anymore. Do you suggest saving a little bit to put into a retirement account and paying the company when you're paying on the student loan, or throw it all in the student loan, or throw it all in your retirement? I'm not sure what to do.
So that's a
You're reading my mind.
Yeah, that's a great question. So for those of you who may not have heard, she was asking, what's the best course of action? Is it to pay down your student loan, make the minimum payment, or invest that money that you could be paying on the student loan into a retirement source, retirement funding? I'll channel Steve's answer on this, which says, there is no right or wrong answer. We can give some guidance on what we feel is the best answer, but you're going to have to make that decision based on your own financial goals. I personally set an objective to get out of student debt. Therefore, I was spending more money paying down that debt. One thing to keep in mind, if your interest rate is 6% on the student loan, just to throw out some examples, you are paying 6%, accumulating 6% interest monthly, so your balance is growing. If you were to invest some money in a retirement fund while also paying, on student loans, if you were to get 6% return through an investment, you would actually be breaking even. So any money you were to accumulate in retirement could result in a break even if you're paying interest on student debt. So my personal philosophy was to try to get out of this high interest debt as quickly as possible, and that would free me up in the future to be able to get other loans and invest money down the road when I felt like I really needed to start that retirement plan and kick it into place.
Steve, do you want to chime in on that?
Yeah, I agree with what Ryan said. There's no right way to do things. It ends up being your personal preference. I'll tell you what I would do if I had it to do over again. I would do both, as my budget allows. The difference is, was the student loan, you're going to have to pay that back. You quit paying on that, someone's Guido's going to be coming, knocking at the door sooner or later. Whereas if you never invest, nobody's going to say anything. So that is arguably harder because it's completely voluntary. You can't make up for time. The biggest thing with investments is time. And that's why I would try to do both, even if you just do a little bit with investing. The example I gave earlier, going to age 65, there's the compounding of interest over time is very powerful, and you just can't make up for that. Even if you put more money in the investment later on, it's still sometimes hard because time will get away from you. Pretty soon it's 10 years down the road, oh, I finally got around to investing. So it's like with everything else, you can do more than one thing at a time. So that's what I would do.
Yeah, as you start to get closer and closer to graduation, you want to look at when you are interviewing, you want to understand the whole benefits package of your potential employer, because you're hiring that employer. Yes, they're hiring you, but you're also hiring that employer. And to Steve's point, I was the person that had to play catch up. I had to pay off my student loans. I served in the military. I didn't plan for retirement until it was late. So I personally have to put 25% of my salary away now to prepare for when I retire. And that's a lot of money, right? But it's also nice to work for a company that gives you a nice, sizable 401k match. And so how 401ks work is they will match up to a certain percent of what you put in each month for your retirement. And then after a certain amount of time, you become vested. And so when you're vested, that means if you ever leave that company, you can take it with you and reinvest it into another plan, if you so choose to do so. But, so talking about that, Steve, do you want to talk a little bit about the importance of 401ks in the workplace and elaborate a little bit more?
Sure, and did we see a question out here? I saw a hand. Yes, sir.
Yes, I have a question regarding, we know that we need to save some money right now for us in the future. But the only problem is, like, as I see for me, as much as I receive more income, I spend more money. And in spite of you saying, like, you should save to invest, it's like every single time that I receive more money, I spend more money. And if I don't receive that money, I spend like a normal amount of money. So I know, I just want to know like how you use your strategy to save your money, because sometimes I feel like I know that I need to save. The problem is like how? Do you separate like by necessity items you need to buy? Do you save like in another form? Like how do you do like some kind of like guide for us at least?
Steve, can I answer that
Sure,
really quick? Because
sure.
I had a problem with spending. I'm going to be really transparent with y'all. I mean, who doesn't want a new pair of shoes, right? Can I get an amen? So what I had to do, like I'm going to be really real. This is my strategy. Like I love shopping, and I love it's the activity and the hunt for the best bargain.
Well, the first step is admitting you have a problem.
Right, exactly. So what I had to do was decipher between a need and a want, right? Is it a need or is it a want? Do I want to retire early? Do I want to enjoy life when I'm retiring? Or do I want to enjoy life right now? There's a healthy balance, but a lot of times you have to make sacrifices, and we're in such an immediate society these days that we want everything now and we want it fast. We want it the way we want it, right? So this is what I did to wean myself off, because it was more about the activity and not necessarily the purchase. I would put stuff in the shopping cart and walk around the store, and then I would say, okay, Pam, do you really need this or do you just want it? And then I would end up putting most of the things back. And because I had to decide what was a need and what was a want. I got my fix, but I didn't go into debt over it. And so I don't know if that is speaking to anyone or if that strategy will work, but it's important to understand why you're spending money and what's your motivation for it, because a lot of it's psychological, whether you want to believe that or not. And so it really is about what is a need and what is a want, and they're two totally different things.
It is psychological. I agree with that. So it's hard to say what it's going to take for you. Everyone has their own trigger. I thought that was a great example. And but you walk around the store with it, and a lot of times, well, that'll wear off after a while. I don't need it as much as I thought. Sometimes it's the scared straight. Now, I had this happen with a dentist one time. When I was a kid, I don't have many cavities. I think I only have 2 fillings, which I hear is not much. I don't know. But I went through a time when I was in grade school where I didn't get cavities, so why brush my teeth? Now, I'm not going to brush them every now and then, because I wasn't a total slob. But then I went for a checkup, and the dentist says, well, young man, you have great teeth. You don't seem to get cavities or anything. It's a shame they're all going to fall out. So, well, what? Oh, yeah, well, you don't floss, and your gums, you don't brush, you don't floss regularly, your gums, you're going to get gum disease, and those nice teeth you have are going to fall out. And then you're going to come back to me when you're older, and your mom's not paying the bill, and you're going to have to pay for implants and thousands of dollars, and it's very painful. But, hey, I'll make a lot of money on it, so it's okay. But I've been flossing and brushing my teeth ever since, so that's just what it took for me. So what I tell a lot of people is, you just have to know, if you don't find the secret for yourself to spend less than you make and be disciplined about it, you'll be old one day, and that person you see out there at college and 9 Mile Road saying, I will work for food, you will be that person if you're not careful. So that's my scary story too.
Yeah, and I think too, a lot of
a lot of things that people take for granted and don't really share is another thing is when you get a raise, you put that raise into savings. If you're living comfortably on what you have, then take that extra money, the money you're not expecting, and put it aside. If you work for a company where you get a bonus, some people have a philosophy of putting that money into your retirement. Some people are like, this is above and beyond. I worked hard to get here. I'm happy that I received it, so I'm gonna go on a trip. But, it just depends. So you have to know you, and you have to really ask the hard question of how am I motivated and how am I wired? Because it's like drinking, right? Some people can drink and not get addicted, and some people drink and they spiral. Same thing with money. She had a question back there.
I already had a question, I just want to agree with what you just said. My methodology is make this clear.
Yeah.
Anything extra, gifts, a raise, automatically, I don't see.
Yeah.
Because I have the money going somewhere else. So I have one account for my bills, and
Yeah.
that's what I concentrate on. So if I want to play money, I have a designated amount each month to play with, and I stick with that year after.
That's a good strategy.
Yeah,
Everything else goes to savings.
That's one of the things I was going to mention. If you are employed with an employer or receiving money through a direct deposit of some sort, you can have that typically directed into multiple accounts. One of those strategies that I've felt has really helped is sending a portion of that into my savings account or into some other account that I don't have ready access to. So you can sit down, determine what you need to get by, pay yourself a little bit to enjoy things and to eat and things like that you're going to have to do on a monthly basis, but set aside that other money going into savings and do whatever you have to do not to touch that. It will accumulate, and you'll learn pretty quickly that you can survive off of that amount that you calculated at the beginning of each month.
Yeah, that's a good point, Ryan. It's very, very practical. Most financial institutions, it will let you set that up on autopilot. That's what I call it. That's what Panera does, where you can say, hey, I want $50 a month or $100 or whatever it is to move from this account to that account, so you don't even have to think about it.
Yeah, you can label them. And Ryan, you were talking about, I think, first of all, I think this is a great question that you sparked, and it's great dialogue. But you do need to pay yourself to be happy, but you can pay yourself, your future self. That's the part we tend to forget is, we want to pay ourselves and we want to take care of things now, but you got to also keep in mind your future self and making sure that you pay for your future self. Yes, ma'am.
Just really answer this question, but I know for me, I had a really big problem spending money. And so when you make more money, you're just playing into the cycle of the work and kind of what's going on in the career cycle, just working and working and working, and constantly not building wealth for yourself. And I would say two things. Either put them into a CD, certificate of deposit, where you can't touch it and it builds interest, so you're making money as you sleep. And that's more satisfying than buying the new Jordans. Or you're investing it. And then I know for me, when I first invested, you start to lose, you lose 50 cents, and you're like, oh, I gotta take the money out before I lose more. But it grows, trust me. And then when it grows, you're like, okay, this money's growing. I'd rather it grow than to spend it. Because I can't see it grow, if I'm just, it has shoes sitting right there and I'm just looking at it as I'm investing in myself. No, you're investing in yourself on E-Trade. You're investing in yourself on the stock market, or in the CD. Yeah.
Weight Watchers has this great saying. I don't go there, obviously, but they have this great saying. It says, nothing tastes as good as how I will feel losing weight. And if you take that statement and say, nothing feels as good as watching my money grow, I think that there's some value in that. Steve can't talk about this, but I invest money. I have my 401k, but I also invest money. And you have to have a strategy. So when you're young, you're obviously in it for the long term. So you can have a higher risk appetite for things when they tank, because you know that even though the stock price may drop, that means you get to buy more shares. So when it starts climbing up, you make more money, right? But as you get older like me, and I want to retire in 5 or 6 years, my strategy is eventually going to have to change, because I want to make sure that I don't lose that money, because I want to get to a point where it stays at a certain level, so that once I get that number that I have in my head in my retirement funds, that I can retire and say, peace out, been there, So it's all about your strategy. Yeah.
And it is true what you said about it gets easier once you start seeing some results. The hardest part is starting. Once you see it growing, you can actually take it to the extreme. We've all probably read stories about that. The person living in a cardboard box, has $2 million, in the bank. So that's not healthy either, by the way. So don't do that. You just have to find a happy medium.
Yeah, don't stuff your mattress.
Yes, and I knew a guy actually that happened to. Didn't trust any financial institution, so he hid money in the walls of his house. These electrical receptacles, he had them in his house, and they worked, but they were specially designed where they would tilt out, and there was a little box, like a little safe box in there. You could fold up some currency, put it in there. So he had done this, saying, I don't trust the banks, the government's watching me, all that off the grid stuff. Well, his house burned down. So he goes to tell his insurance agent, I happen to know his insurance agent. Goes to tell his insurance agent, I had $50,000 stashed in my house. And the insurance, what do you think the insurance agent said? Well, yeah, good luck with that. That money's gone.
You can't prove that. Yeah, we could tell you all kinds of stories. I think the most impressive thing as a banker is to see someone come in a white t-shirt, a pair of jeans, dirt on their boots, they walk in, and they're your most profitable client because they have hundreds of thousands and millions of dollars stashed away, and you don't know. It's not the flashy person who has nice shoes and the expensive purse. It's the person that walks in. That's the person who's in power, because you don't know. No one knows what they have. And so if you take that mentality of, like, I have power because no one knows, and I'm just socking that money away. And then one day you come out and go, boom. So, Brian, this is probably a good question from an educational standpoint. My FI won't approve me to get a credit card. What should I do?
Yeah, great question. So I'm going to go back to the first answer that I had on building credit. If the denial is based on your credit history or anything related to a lack of credit, go back and look at what products that your financial institution has to offer to help you build that credit. If they don't have anything, find another financial institution, because one of the important parts, especially in the credit union movement, is that we are offering things to help our members. So that's number one, depending on what the reason for the denial is. The second option is learning from your financial institution why they denied you. Again, that kind of goes into the initial statement, but it could be based on your income in relation to what your debt is. So as the gentleman pointed out earlier, if you've accumulated too much debt, your living expense, your rent is too high in relation to what your income is, you may not be able to qualify. So those financial institutions are going to have to look at your credit and then your income in relation to your debt to determine if they're able to approve you. So if you find that to be the case, I recommend working with either someone in budgeting, a financial counselor, to help identify where your expenses are going each month and see what you can cut out. Chances are there's things that can be eliminated or downsized that can help you qualify if it was based on your income.
I'll share another personal story. Several years ago, my ex-husband lost his job, and I decided I was going to take a job for less money. So right there off the bat, we had $75,000 less coming in. And you sit there and go, oh my gosh, it's amazing how much excess we blow. And when you're forced to really look at your budget and really double down is what I would call it, you spend a lot of excess on just frivolous stuff. Going out to eat will eat your budget like that, like big time. And making impulsive purchases and impulsive decisions. And, do I need the, Mac Daddy cable bill, or can I get by with no cable? I mean, that right there is $1,200 easy, probably more like $2,400 a year right off the bat. So there are things that, if you aren't doing this already, you might want to keep track of your expenses and just write them down for 1 month. March 1st, this starts this Sunday, and just start writing down your expenses. No judgment, oh, I probably shouldn't do that because I have to write it down then. Just write it down, just so that you can see, or go back in your statement and see. Most FIs have a money management tool that's tied to their online banking that can tell you. You can set up buckets of how your money is being spent. And it's pretty eye-opening. Like mine it's all like food, because I always eat out. So when I looked at that, I was like, oh, I probably should change my behavior, big time.
Yeah, it's harder in today's world where everything is accessible at our fingertips.
Yeah.
And so you have to have a strategy to overcome that, or it can consume you. So I really encourage, like Pam said, make a budget, make a list of your expenses, see what your income is, and not just what your income says it is. Look at what you're actually bringing home after your taxes and everything like that, and make that budget tool.
So why do financial institutions do credit checks just to open a savings account? Instead of savings account?
Yeah, that's a great question. So the credit checks, most of the time, the credit checks on accounts and memberships. Excuse me. So most of the time, the credit checks on memberships and savings accounts are what they call a soft inquiry. It's going to take a look at your credit and identify if there's anything in the past that has either caused a loss with that financial institution. There's some other checks that go on to ensure that you don't have bad checking account history out there. So they're going to run all those simultaneously. But the other part is so that the financial institutions can get an understanding of your financial history in order to know you better as a member or a customer of theirs. So there's a few different reasons, but a lot of it is due diligence based on the history. Typically, again, I'm not going to say every time, but if they're doing a soft inquiry, it's not going to impact your credit in a negative way, but that's something you'll have to have a conversation with who's actually pulling the credit at the time. But they're not doing that to necessarily, penalize your credit or anything. It's more up to know you as a consumer.
Yeah, it's a business decision. Check the risk that they're about to take on. So.
Yeah, the other thing with that, and this is more, what Ryan said is true, and he knows about that. So this is mainly my opinion on the matter. I've always viewed the credit reports as kind of a look into your character, your financial character. You go into an institution and you say, hey, I want to open an account. And they're wondering, is this person worthy to open an account? Are they going to live up to their end of the bargain? Are they going to keep money in the bank when they write checks? So your credit report, you say, well, Mr. Smith, yeah, you want to open an account, and you say you're a good person, your credit report says you don't pay your bills. You don't know if we want you. So that, I'm not really big on managing the credit report, so to speak. I'm not even sure what that means. Ryan probably knows. But to me, if you pay your bills and you use credit responsibly, the rest kind of takes care of itself.
Here's a really good question that I think is a good rule of thumb that we should talk about. And you hear different schools of thoughts, but what do you guys recommend as what would be the typical number of months of expense that you should have in a savings account before you start investing?
Oh, I don't believe it's spend it all. No. Yeah.
That's his job.
Yes. Most metrics, most financial planners will say 3 to 6 months living expenses. Maybe even 12, depending. Now notice I said living expenses, not income. And so if you're living on less than what you make, which you should, so 3 to 6 months of living expenses is going to be less than 3 to 6 months income. And the reason that is, I like to, personally, I keep more than that. I keep closer to 12 months just because life happens. That's what it's there for. Your spouse loses a job, like Pam was saying, things happen. Well, then you can continue on. You can continue on with your investment program. You can continue on living life without having to start jettisoning all your cargo because you have prepared in advance for that. You know, the idea I get asked all the time too, well, what should I do with that money? It's just sitting in my savings account, not earning anything. That's okay. The point of that money is to be safe and accessible, not to get a huge return. So leaving it, even though it could be a sizable amount of money, leaving that in your savings account is perfectly acceptable, in my opinion. I know people that don't do that. I know people that invested in the stock market. So, well, you know, more power to them. I've got plenty of money invested in the stock market. My cash reserve and savings is not invested. It's sitting in the regular savings account.
And another option too is basically your savings accounts don't necessarily, they pay the lower end of the spectrum on interest. Another option where your funds are still liquid would be a money market account. And with a money market account, those pay a little bit higher rate of interest, but it's not tied up like a certificate of deposit or a share certificate. The thing, the boundaries or parameters on that is you cannot write more than 3 checks a month or make more than 6 withdrawals a month. So, but Brian, what do you think?
Yeah, I wanted to tie that in. You know, Steve's got the investing side, but the credit side, just to mention, if you don't have that nest egg or that safety net set aside for 3 to 6 months of living expenses, and you do go through a hardship, whether it be loss of a job, a medical emergency that you were not expecting, it could actually impact your credit. So think about all of the accounts you may have out there one day, from an auto loan to a mortgage to some credit cards and some other loans that you may have. If you don't have a safety net and something happens that you have to pay for immediately up front, you may have delinquent payments, or you may not be able to make a payment on a certain loan. So the safety net's very important, not only from just getting by living, but also in maintaining your credit and not having to go out and rack up credit either if something occurs. So I agree, 3 to 6 months is reasonable, but it's going to depend on your situation and exactly how much you've gotten saved up in different areas.
One of the questions we usually get is, how is the best way to go about paying off my debt? So do you guys want to share some best practices that you have experienced or heard of over time?
Yeah, I think a lot of what we talked about is going to kind of go into that same answer, which is understand your budget, understand your expenses, write them down on paper, and then develop a reasonable plan to paying those off. So minimum payments are out there. They're on almost every loan or credit card you look at. However, that does not always equate to the best option for paying off the debt quickly. So develop that plan, write those down, use an online tool to know what your expenses are, compare that to your income, and then do as much as you can to apply extra to the principal of credit cards and other types of loans. If you can look at how much you're going to be paying, how much you're going to go to the principal, you will know 2 years from now I can have this paid off. Even though the term was 5, you can achieve that by paying extra, paying double on the amount if it's within your means. But the first step of that is really establishing what those expenses are, and if you have the means to pay more to get out of debt. One important thing to note, as Pam talked about retirement, as Pam discussed, some long-term plans in your future. If you are carrying a lot of debt into retirement, it's going to be a lot harder for you to step out of that job, in your 50s or 60s or whenever that time comes. So the goal should be to get out of debt as early as possible, but keep in mind that if you're continuing to accumulate that debt, it can actually delay your retirement. And I think most of us can speak. I love thin air, but I want to retire as soon as I can so that I can enjoy life. So it's something to keep in mind on the end goal there when you're evaluating all of this.
Yeah, I agree with everything Ryan said. A practical idea that I've seen work, that I've used myself, is you have multiple debt. Pay as much as you can toward the smallest one first and get it paid off. Then take everything you're paying toward that one and put it to the next largest one, and so on and so forth. So it just kind of snowballs and builds up. it does two things. Number one, it helps you see the results because you're getting that smallest one paid off first. You go, oh, I've done something, I'm feeling good. Then you're channeling all that money, directing it toward the next largest one. Pretty soon it gets to be a little bit easier to pay them off. You get really encouraged. Pretty soon you start going, I'm just driving by Starbucks. I'm not going to spend $5 on the latte because I'm going to put it toward my credit card bill.
Yeah, knowing the terms of the debt as well, like Steve mentioned, there's all going to have balances, but they all have interest rates typically. So evaluate that in the pay down process. If you have a $5,000 credit card balance that's 30% interest, you most likely would want to apply as much payments as you can to that account versus a car loan at 2% interest. So you'll want to look at that. You'll want to pay down the high interest debt as quickly as possible as well, because it will compound at a much faster rate than, say, your auto loan at 2% or your mortgage at 3 or 4%. So evaluate that. There's a lot of credit cards out there. Unfortunately, sometimes the easiest ones to get are the highest interest rates. So know your interest rate, know how much you're paying monthly and compounding, and use that in your strategy to pay down the debt by paying off the high interest debt first if you can.
And I know we got two questions. I want to also, a best practice that I've adapted, and you have to know yourself before you can do this as a way of daily living, but I used to use my debit card exclusively to pay for everything. And I'm now at the point where what's important to me is that I get to go see my granddaughter who doesn't live in Pensacola, Florida. So I've changed my spending habits to use a credit card that gets airline miles. There's credit cards that provide rewards, but you have to pay attention to the interest rate, but you also have to know yourself well enough to know I'm not going to dip into my cash flow because I know at the end of the month or every so often I've got to pay that card off. But what it does is it gives me, I'm not changing the way I'm spending money, I'm just changing how I spend my money, right? The payment process, but it also gives me a reward and benefit back so that I can take a trip or I can use those points to do something else. You had a question and you had a question, so you want to go ahead and go first?
Yes. So my question is for you, Steve. It's regarding investments and our current situation in the stock market about coronavirus and everything. So last week, all the stocks went down, and today, it's still going down. Apple reached, I think, in the past 6 months, the lowest rate they had. So what do you expect to happen in the stock market? What would you say? I invested some money, I was winning some money, I lost some money. So I'm kind of learning, so I kind of want to know about your experience and expertise about this. So in my opinion, I believe that once you have a cure or something for coronavirus, everything is going to go up again. Mm-hmm. But I don't know, it's a long investment, I don't need the money right now. But that feeling that losing hurts more than winning feels good. So I want to know how long it's going to take, for every kind of situation, and how would I expect the market to go along with it.
Well, of course, if I knew all that, I wouldn't be standing up here. I'd already have an island somewhere. And it's a legitimate question, though, because it is scary to lose money. I don't care who you are. I've had people tell me, well, if I had more money, I'd invest in the stock market because I could afford to lose it. And I said, no, you wouldn't, because I deal with plenty of people that have more money than they know what to do with it. And guess what? They don't like to lose it either. No one likes to lose money. The coronavirus, whether there's a cure or not, it's gonna pass. The headlines in the media a lot of times influences the stock market. People panic. As long as you have a long-term time horizon, doesn't matter. Doesn't matter what happens with the coronavirus. That sounds strange. I'm not being insensitive and saying, well, he thinks people should just die from the coronavirus. It's not that. I mean, it doesn't matter in terms of headlines, because that will pass, and the stock market will go up. Then it's going to be something else. Then it's going to be the election, or the president tripped over a dog going out to get his mail and broke his arm. Oh no, now the stock market's going to go. It's always something. I have a chart that I show people sometimes times, showing, going back to the early 1900s, all these disasters. It's amazing how many disasters. I mean, every year, going back to the 1930s, it's something. It's not the Vietnam War. It's Nixon resigning. It's another corona-type virus. It's always something. An interesting thing when you look at this chart, and it's a chart of the stock market, by the way, is it goes up over time. Does that mean it goes up every year? No, it does not. There's sometimes it goes down more than 1 year in a row. But the trend over time is always for the stock market to go higher regardless. There's going to be the disaster of the day. It's going to come every single year. But still, the stock market goes up. Well, why does the stock market go up? It's based on businesses and the profitability in industry. And that's why it continues to go up. So if you're thinking, well, something is going to come up. If it's not the coronavirus, it's something else. And the stock market's going to crash. It's going to go to zero. Everyone's going to lose all their money. That's technically possible to happen. I don't think it ever will. Think about it. For that to happen, all the businesses globally would have to shut down. So when you look at the fundamentals of the stock market, it's driven by business and industry and people making innovations. Then you start to be able to look past the headlines and say, okay, I don't like that the stock market, at least when I left to come here, the Dow was down 800-900 points, which really is only 2.5%. Really not much at all, but it's down 900 points. That's bad. When you get your perspective and long-term time horizon, you start to be able to look past that and say, it doesn't feel good, but I'm going to remain invested so I can reap the rewards later on. And history has shown that that works. We can't predict what's going to happen, but we can predict if you remain invested in good companies, over time, you will make money.
Yeah, just to elaborate, one thing I've kept in mind as I began investing was you haven't officially taken a loss until you pull that investment out. So, as Steve mentioned, that's a long-term strategy. It's very important when you're investing in general. But if you pull the money out, you take that loss. If you are able to leave it in, if you're optimistic that you're not officially losing that money per se, because it could grow back to the same point. I know the Dow's down 900 today, but it could be up 900 tomorrow. So it's one of those situations where you're going to have to decide what's best for you in the strategy.
Well, and two, if you've invested, you have shares or you have stock, right? That stock is still there. It's the value that has decreased. If you were around in 2007, 2008, real estate around here in the whole world crashed. My 401k was practically non-existent, like legitimately. But over time, because it's not a sprint. Investing is not a sprint. I mean, there are sprints you can get lucky on, but very few and far between happen. It's more of a marathon. It's a long-term game. Gentleman in the back, you still have a question?
Yeah. So what would you consider to be good debt?
Good debt.
Good debt, yeah. So the question was, what would we consider to be good debt? Good is a very generic word. I think, again, we'll have to put the disclaimer that depends on your situation. However, at some point in time, the majority of us in this room, 99%, are going to acquire some debt. At some point, the key is understanding when you need to accumulate that debt and making sure the returns are reasonable for what you're expecting, whether that be a mortgage. Again, that's going to be the most common that most people are going to have to accumulate at some point. We all have $100,000, $200,000 in cash to pay that clear. But same thing with auto loans. Again, auto loans are more expensive today than they've ever been. To find a new car, you're most likely spending anywhere from $20,000 to $40,000, depending on what you're looking for and above. So, one thing to keep in mind is what are the terms, what's the interest rate, do I have the means to purchase this in another manner? You may not want to deplete all your cash, and that's where I'll put that out there as well. There may be something where you have $10,000 in the bank, but the price of that this item is 10,000 that you really need to function, or that it's something that you wanted to acquire. And so it may make more sense if the interest rate is low to take out that loan, establish that credit, try to pay it down as fast as you possibly can. So that may be a situation where you could categorize it as good for your situation at that time.
Ryan touched a little bit about good debt, and he's talked about mortgage. How many people in here know, rule of thumb, how much you should spend on your housing, whether it's a mortgage or rent? What percentage of your salary should you be spending on that? It's 30%. So if you make $10,000 a month, you're winning in life, right? But
Bridget, yeah.
I know. So your mortgage should not be more than $3,000. So 30% is a lot. So that's one of the biggest decisions. So most people can afford a mortgage, but they don't think they can because they don't think they make enough money. There's an opportunity for you to, if you're going to spend that much money, then you probably want to invest in a piece of property that could have potential long-term payback in your benefit.
Yeah, if you spend 30% on a mortgage, you may have to compromise in other areas, and so that's something to keep in mind. When a creditor is looking at your financial situation and determining if they can approve you for an auto loan or a mortgage, they're going to look at your total debts. So if 30% is to a mortgage, and then you've got 20 or 30% on other debts out there, you may have challenges getting a loan depending on your credit history. So I would say when you're looking at your financial picture, try to minimize how much debt you have in relation to your income and look at it as a total. I know we've probably all seen the scenario where somebody has a really, really nice house and they're not able to afford other things. There's a term out there for it, but same thing with vehicles.
House poor.
House poor, that's the term. So, you've got the great house, but you can't afford, to go out to eat or go on vacation and do things to keep your quality of life. But same thing can be said about a car loan. You may, make $3,000 a month and be spending $600 a month on a car payment and not have that income to apply when you need to go buy a house. So keep that in mind. Try to keep your expenses low as a relation to your income, and that will help you in the future if you're trying to qualify for loans.
And let me just put this disclaimer out there. The average is 30%, and it's kind of like what I like to say about spandex. Just because they make it in your size doesn't mean you should wear it, right? So if the rule of thumb is up to 30% and no more, doesn't mean you have to spend that, right? So more money in your pocket for your retirement if you don't spend that much.
That's right, and conversely, when you're younger, just starting out in your career, you get your first job and everything, it's hard for me to live and only spend 30% on housing. I'd be living in a cardboard box. The apartment rent is this, I'm only making that. So it works itself out over time. What I would advise is that don't fall into the trap like Nan said, just because you're making it, you got to spend it. Well, now I am making $10,000 a month, so I got to buy a $750,000 house so I can get back into that 30% range. The people that really build wealth, like we mentioned earlier, the guy walking in with jeans and the lady just not driving a used car, and they could have tons of money because they have resisted the urge. It's called lifestyle creep. And just because you make more, you start spending it. And that's not to say don't enjoy life. You just have to do things in moderation.
Yeah. You had a question.
Yes. So my question is on real estate. What do you guys suggest the correct method is, or what do you see most commonly when houses are repossessed, and so people want to buy them and possibly flip them and give you guys.
Called Chip and Go Join Games.
Yeah. Go to one of the seminars that we all hear about on the radio. No, so I'll put a disclaimer, mortgage is not my area. I deal more of, auto loans, and credit cards, things like that. But there's a lot of programs out there in terms of mortgages. And so the biggest thing is determine what's the need. Talk to your financial institution and then see if they've got a program to qualify you. There's some investment programs that you qualify under to get a flip type house there. And so it's something you're going to have to discuss with the institution. They're also very different. Some are willing to take some of the risks that others aren't. So it's very important to know and understand what you're trying to do, communicate that with the experts, and then let them give you what options you've got. A lot of times I know investment mortgages and things like that, you're going to have a higher interest rate because they are riskier. It's not your primary home. But one of the keys in identifying what your options are is really understanding that picture and communicating that.
Yeah, there's a plethora of loan types and programs out there, like to the point that you have to be certified to talk about it, so we can't really talk about it.
But just bear in mind, all investments have risk. That includes real estate. There's no such thing as the risk-free investment, except for someone trying to sell you something. I've actually had someone sit in my office and said, I only do real estate investments because everybody knows you can't lose money in real estate. This was back before '08, by the way. I mean, you can lose money in anything. I don't care what it is. So you just have to be careful and do what you're comfortable with.
What questions do you guys have?
I do have actually 3 questions.
Ooh, hit us.
Okay, so the first one would be, what kind of resources are out there for young entrepreneurs, for example, that I don't have access to a email account? Second one, what about things still, the reason why I'm asking the second question is because, for example, my dad, at this point, 40 years in the end, somebody talking about investing some money into something that you want to keep out of his 401k that you get set for his career and invest in something else. Actually, that was a good thing because when he had a gift with the 2008 crisis, that was just disappeared.
Yeah.
And so, on the 401k still structured that way. And my third question is, for somebody who has student debt, that most of us would relate to. When you go and apply for a mortgage, being a first-time home buyer, because that is something that you got financial institutions take into account as well as your income.
Yeah, great question. So I'll tackle the first one on entrepreneurs, business loans, things like that. Based on your situation with your business, there's tons of programs out there. If you were just starting a business, my recommendation would be go to the Small Business Association. They have grants, a lot of resources out there that are going to talk to you about what options do you have. It is a little more challenging to get startup loans than it would be if you've got an established business. However, the Small Business Association is a great resource.
And there's one on campus. Good.
Yeah, they're a great resource. I would go there before really going to any financial institution. However, if you are established in a business, most financial institutions, including Air, are going to have products out there. One of the things that they really want to see is 2 years history of income. So they're going to look at your business and your history to see, okay, they've made $50,000 for 2 years straight. Here's what products we might have available to them. But definitely start out with Small Business Association. They've got a lot of resources that can get you set up. So, and I'll go ahead and tackle number 3 too while I'm on the mic. But the student debt does factor in for most lenders into your, we'll call it debt to income ratio. That's the relation of your debt to what you make on a monthly basis. So it is up to the lender. So there may be some that do not include that. But whether it's deferred or whether you're paying on it is going to be one thing that's going to be considered. If it's deferred, most lenders will take a percentage of that as a monthly payment just to use in a calculation. If it's not deferred, they're going to look at what your monthly payment is, and they are going to have to add that into your total liabilities, your total debts, to see, do you have the income to pay back the loan you're applying for. So we do always, that's one of the reasons we encourage to pay that down if you can. Try not to accumulate as much as you can, and that way it'll help you when you need a loan in the future. One other thing out there, I want to make sure to note, delinquent payments on student loans also go onto your credit report. So there is some misinformation I've seen in certain places that those don't really affect your credit. They do. So make sure you are on good terms. You're following up if deferment is changing. Make sure that you're making those minimum payments and coordinating with whoever's servicing your student loan to ensure that you're keeping up with the payments in a timely manner. A lot of times that is what can hurt your credit score when you're coming out of college is some mispayments throughout school.
And I heard something on the business lending side from our business lending officer in there that might be helpful to you. So I'm just parroting what he said. This is for if you're getting a business loan from a financial institution. Like Ryan said, 2 years income tax returns, and they want to see that you're making money, and a 600 credit score. What banks and credit unions do not want to do is loan the money to a startup with no experience. And, hey, I want to do a car wash. I see all these car washes around here, and they got 1 million cars going through them, and they must make a ton of money. Well, I have a chance to buy a car wash, only costs $1 million. Will y'all lend me the money? Credit union says, well, show me where you've run a car wash before. Well, I hadn't, but it's a great idea. And, well, you need to go somewhere else then. And there are other places that may lend you the money for that. Like Ryan said, the small business development centers. Sometimes they can hook up with individuals that are willing to take a chance on them. On your 401k question, 401k regulations are very complicated and they're always changing. 401k, for those of y'all that want to bore someone at the cocktail party, you can say, you know what a 401k stands for, where that came from. That's section 401 of the Internal Revenue Code, subsection K, that allows those to exist. Nonprofit organizations and hospitals have 403Bs. That's section 403, subsection B. So that'll usually make people leave you alone if they're bugging you at the cocktail party if you tell them that. Now, they're governed by all those they're called employer plans. They are governed by what's called ERISA. It stands, the government regulation stands for Employee Retirement Income Security Act. A piece of legislation passed in the 1970s and has changed throughout the years. And it's very complex, designed to protect the employee from employers doing improper things. Generally, you cannot take money out of a 401k plan until you leave that employer. But you get a job, you get your 401k plan, you generally cannot take money out of it until you leave that employer. You don't have to retire. You can change your job. Then that 401k can follow you to your next employer. And it's set up that way because it's not designed to be something you tap into to start a business or to buy a car or to do something else. It's designed for your retirement. So that make it very difficult to get to. I know people that say, well, I don't do the 401k because that's my money and I can't get to it. Well, you can get to it, it's not right now. It's designed to force you to save. You'll be glad you did when you get to be generally about age 60 or so and eligible potentially to retire, maybe 65 or later. And then, now it's designed to tap into that money. Use it where you built up that money in your working career, now that money will help take care of you later on. So I can't speak to what your dad did without you seeing the particulars of the situation, but I do know people that have retired, taking the money out of their 401k and done other investments with it. We help people do that too.
Yeah, but I guess my question was that you still have the mercy of the economy tax that means you know what is done too. But that's what happened to my gas.
Oh yeah, it depends on the investment, not necessarily because it's in a 401k plan. It depends on how that money is invested inside that 401k plan. So yeah, it's still subject to whatever the financial markets do. It's still subject to that.
Yeah, most 401ks that are provided by an employer, Steve probably speaks to this, but I think they give you options on how you want to invest that. That's how Pioneers is anyway. So some of it's still in your hands as the owner of that 401k, but yeah, it's definitely at the mercy of what you decided or what your plan has decided to put that money into at the time.
Most plans are required to give you at least one safe option. Pioneers is just so worried about.
Conservative?
Yeah, oh, well, conservative could be one way. Also, if you're laying awake at 3 o'clock in the morning saying, oh my goodness, my 401k is now a 201k, I can't take it anymore. Then you can get out of the stock market, so to speak. You're still in the 401k plan, but you have the safe option. So it's usually, sometimes it's called a stable value fund. That's what ours is called in there. Sometimes they call it a guaranteed account. So the good side is, now I don't have to worry about the financial market. Bad side is, I'm not making anything. When I say not making anything, it usually is almost nothing. For example, less than 1% a lot of times. So, but it gives you a place to go so you're not always at the mercy of the financial markets.
You know, when you get into the corporate world or whatever line of business that you decide to go into for your job, you're going to work hard. And so you owe it to yourself to make your money work hard for you. And we've got about 6 minutes left. So does anybody have any questions that you want to ask in front of the group? We'll stay around afterwards if you have anything that you feel more comfortable asking one-on-one. Anybody else have any other questions? All right, well, we'll give you the gift of time, which is also valuable, right? And thank you for coming today. If you could take a minute to fill out the questionnaire in front of you, we always want to improve on what we're doing and know what we're doing right, and have an opportunity to improve on what we're maybe not doing